Hey guys, Shannon here with Remax Services. I'm actually here with my buddy Stephen Balby from Loan Depot. Recently, I've been getting a lot of mortgage calls with the rates going up, and I thought it'd be a good idea to talk about different programs that are available and bringing in the expert to do so.
Absolutely.
So, first and foremost, what's the difference between a fixed rate and an adjustable mortgage rate?
The easiest answer there is that a fixed rate has a rate that is fixed for the entire period of the time. So if you were to qualify at a 3% and you close at 3%, your interest rate will stay 3% for the entire time you have that loan. If you have an adjustable rate mortgage, the rate will be fixed for a much shorter period of time. Oftentimes those rates seem a little bit more attractive. They offer them a little bit of a lower introductory rate, and then after that set period of time, the rate enters into what's called an adjustment period. And from there on, throughout the remainder of the loan term, the rate does have the opportunity to adjust and fluctuate up and down.
Now, are we seeing them a lot more often with rates kind of skyrocketing and being fixed?
It depends on the program, but we are seeing a slight increase in that type of program. Again, depending on what type of home you're purchasing, whether it's your primary investment or a secondary home, and also what your plans are, how long you plan on staying, if you're going to be there short term, longer term. But we are seeing a certain increase in those type of programs, essentially because of the way rates are going.
Okay. Is an adjustable mortgage rate available for different types of program, conventional, FHA, or is it just stuck with one?
Nope, it is. You have many programs that you can choose from. You can do your conventional. There's even some jumbo non-conventional programs. You can do them for FHA and VA as well. One of the only programs you can't use it for is a USDA loan.
Okay. Now, if I choose to go with an ARM rate, am I stuck with that forever?
You are not. No. A lot of people will tend to shy away from it because they get nervous. They think that the rates are going to skyrocket, but you're definitely not stuck with that rate forever. You can certainly refinance really at any time.
And what is refinancing?
So refinance is it's a little bit different, obviously, than a purchase. You're basically just having a lender take a look at your loan and refinance it, essentially reset the term, redo the loan itself for however long of a period, whether you're looking to just simply get into a fixed rate at that point because you have concerns over where the rates may be heading, if you think they're going too high and your rate may go up too much. Some people will refinance at that point to try to lock into a lower rate. Or if you just want to shorten your term, take any cash out, do any debt consolidation. So you can certainly refinance and get into something fixed.
Okay. Well, if I wanted to fix a refinance, when is usually a good time to do so?
That depends. Again, a lot of it depends on what you're looking to do, what type of market we're looking at, whether the rates are. Let me give you an example. We'll back up a sec. So let's just say you have currently a 5% rate, right? Let's say that rate is fixed for the first 5 years, and at year number 5, you're seeing that interest rates in the market are at 7%. Some people might start to get nervous and they think, well, let me take a look. Let me see if I can refinance. We'll take a look at some options. We'll check your normal, your credit, your income, and your equity of the home, make sure it all works, and see if we can put you into a fixed rate. Or interest rates might be the opposite. Let's say you are at a 5% and rates are at 3%. And you figure, you know what, let me grab it now to see if I can get that lower rate. So again, it depends. You just have to kind of look at the situation and see which one is going to make the most financial sense
for you. Yeah.
Correct.
Now, on the opposite end, if I wanted to refinance, what were things that would prevent me from doing so?
Your normal things that would prevent you. If your debt to income ratio had, from the time that you initially purchased the home until the time you refinance, if something changed with your debt to income ratio and now your ratios are out of scope per se, so if you went up over 50% total debt ratio, really, the only other thing is it just depends on you, your credit. I mean, your credit score. As long as your scores are within the realm of qualifying, and as long as your debt to income ratios are in the realm of qualifying, then there's really nothing that should, prevent you.
Awesome. Well, thank you for the quick crash course. Guys, if you have any questions, please feel free to reach out to me, Stephen, directly. I will definitely post his contact info below. It's amazing. Actually, my mom recently used him to refi. I was very, very happy.
Nice.
So any questions you have, he's great to go to.